Very good morning, students. Yes, Nitish, are you able to see the screen?
Yes, ma'am.
Yeah, so that's important because you are going to do the exercises online, so I thought it should be visible to you very clearly. So, very good morning, my dear students. Happy to meet you all in day two uh, revision of paper 4, Fundamentals of Business Economics and Management. And At the outset, I would like to tell you all that the exercises which we are doing in the class, the tips which we are giving you in this revision class is 100% exam oriented. So we are having, the scanners with us. We have marked some important questions. What you can see as repeated question, what is an unexpected question, where there is a small twist. Like yesterday we did, no? Directly certain questions we did. Who gave this definition? What is a publication of this year of publication of this book? Who gave this book? Things like that we did. Who gave this law? Who gave this doctrine? At the same time, I told you these are analytical questions. As classroom exercise, you are taught you have to give time and do. So your paper would be a blend of direct questions and analytical questions. Now finish off your direct questions, and I call direct questions as technical questions, which means they are easy, but unless you read the material, you can't answer. If supposing they gave an essay on the nature and significance of economic science, who gave this? Unless you study the material, where will you know the answer? It's a direct question. And that is why yesterday we began our session with the match the following. You remember the name of the economist and the publication, and that is there in your parent sources. The very first lesson has this. So you finish off your direct questions quickly so that there are a set of questions like graph based, what we did, numericals, which may consume time, analytical questions, no? So example based, some of the questions yesterday were example based questions. That time you had to take time to think and do it. It's not a direct question. So be prepared for two types of questions. Technical questions are direct questions, but again, reading that is very important, and analytical question based on the concept I was telling you, in and around. When you say DMU, you are directly going to law of DMU. But on utility, how many questions they ask? And that is why yesterday, particularly in the classroom exercise, we did on utility itself. Concept of utility, if you remember. Does utility have a material existence? Does it have a legal claim? All these are difference between utility and satisfaction. Are they one and the same? Even that water diamond paradox given by Adam Smith is about the difference between the total utility and marginal utility. So when you do a problem, you did a couple of sums on a TU and MU computation, but the difference is an analytical question, right? So that's what we are going to do. And today also you have this combo of a direct and analytical question. So with the sincere prayers to the Almighty, let us hope that the day two will go very productively for us. Yesterday, with the interaction and inputs from your side, really time flew, 6:30 to close to 12, just went like that. I expect the same level of participation today also, right? Now, yes, Nitish, can you say the topic we have to start today? Let me see. You remember the topic we have to start today? Yes, it is elasticity of supply, because we completed with an exercise on supply. Yesterday you remember conceptual based, graph based. We did a very important 10 solid questions we did yesterday, if you can remember that. And now we are moving on to a related topic only. Okay, so that is elasticity of supply. So that is a topic we are going to concentrate today. Okay. So conceptually we discussed supply, and today we begin with elasticity of supply. Now regarding this chapter, if you ask, ma'am, what are the 4 inputs we have to do? Undoubtedly, the formulaic expression. Okay, the formulaic expression. How am I going to express as a formula elasticity of supply? Formulaic expression is one important thing. The second one is determinants of elasticity of supply. I have exercise for you, so you will be doing that, don't worry. Determinants, you are finding questions from determinants of elasticity of supply. Like, what are the factors that could, like, they will ask you, like, E is greater than 1, under which context? E is less than 1, under which context? So something of that sort is there, which will tell you about factors influencing elasticity. Then methods of measurement of elasticity of supply. Methods of measurement of elasticity of supply. Basically, you formula wise, you have only 2 things, that is 2 methods. One is your percentage method, delta Q by Q divided by delta P by P, where the Q and P denotes, the supply, the quantity supplied and price of that quantity. So percentage method is there. And also the arc method, which you apply for elasticity of demand. So that is also there. Percentage method is there very much. Okay, percentage method is there very much. And you also have arc method. Are you clear? So now, as I told you yesterday, take down the points. Take down the points in the notebook. It's very important, so that you can use this revision notebook as a ready reckoner, quickly to go through. So basically, you can have your elasticity of supply divided into these 3 main components, right? So which is very important. Formulaic expression of elasticity of supply, determinants of elasticity of supply, methods of measurement of elasticity of supply. Okay. Now, yeah, we will go on to the, so look at our first day 2 coverage list, topic list also you can see. We are going to begin with elasticity of supply, and probably we can finish off, we can also attempt, target completion of market structures. So after elasticity of supply, we will do equilibrium analysis, then indifference curve analysis, theory of cost, theory of revenue, market structures. In market structures, we have quite a bit of competition, like perfect competition, monopoly, monopolistic competition, oligopoly, duopoly, oligopsony, monopsony, and bilateral monopoly. Right, and all these are very important for theory questions. And 4 important markets are for graph based questions. So I have this graph clippings also for you to do the exercise, and they are template questions. Now, what are those graph based questions from which forms of market? Perfect competition, monopoly, monopolistic competition, and oligopoly. For 4 of these markets, you have even graph based question, right? Because you understand their equilibrium, price output determination, and you have this diagrammatic or graphical representation of the same. Okay, so that is what this is the coverage. If you can add more, we will add more, or if you are unable to complete, okay, let's see whatever it is. Okay, this is our plan. Now we are starting with this, and here please remember, under elasticity of supply, revise this graph thoroughly. Okay, now you are going to write down the names of each of these graphs. So that is how we are beginning this segment. Okay, revising the graphical segment in elasticity of supply is important. Ma'am, why do you say this? The reason is, when you do a big chunk like elasticity of demand, you feel satisfied, and there is a bit of a chance of ignoring elasticity of supply. So people don't give importance to elasticity of supply just because you read a big chunk of elasticity of demand. I undoubtedly agree that elasticity of demand is important. Even in question banks and scanners and question papers, we find elasticity of demand prioritized, but that doesn't mean that you can ignore it, because unexpectedly you get this. What would you do? Now, what is the first thing you're going to do? See, look at this. You have E is greater than 1. E is equal to 1, E is less than 1, E is equal to 0, E is equal to infinity. So write down the names of all these. Okay. So the graph is given to you there. So what are you going to do? Your first exercise begins where you are going to write the name. How did we study in the class, if you can remember? A graphical representation, title of the graph, formulaic expression, explanatory note, examples were required. You remember this part? How did we do for both elasticity of demand and elasticity of supply? How did we study? Title of the graph, followed by the graph, give the formulaic expression, and explanatory note, followed by examples. Now here, what you are expected to give is a title. Okay? Do it. Okay. I suppose you would have done it. Now let me put down the key for you. Okay. See, as you have to check your answer with the key. That's very important. So now I am going to release the answer key. Check your answers. Okay. Okay. So I pasted this. Now I'm going to write the answer for you. Okay. The first one. Okay. So the first one, ES is greater than 1. So we call this as relatively elastic supply. A relatively elastic supply. Now in the examination, they give you a graph and 4 options would be given. So choose a correct one. It's a repeated question. Okay, graph based question. So relatively elastic supply when ES is greater than 1. Are you clear? Okay. Now the second one. ES is equal to 1. So what is this? I call this as unitary elasticity of supply. Unitary elasticity of supply. Okay, check your answers, and if it is wrong, please take down the correct answer. So from the graph, when they give you 4 options, immediately you must be able to identify the type of elasticity. That's what I'm trying to tell you here in this diagram. Okay. Now, ES is less than 1. I think that's the diagram I've given. Okay. Relatively inelastic supply. Relatively inelastic supply. Okay. Then fourth one. ES is equal to 0. Perfectly inelastic supply. You know, you have this perfectly inelastic supply. Okay, and the fifth one, ES is equal to infinity. Remember, it is perfectly elastic supply. Anybody got all 5 on 5? All correct? Anybody?
Yes, ma'am.
Yes, really? That's good here. Seriously. Very good. So, what is that we learned from this exercise, classroom exercise 1 of this day 2? So here I will revise the graph with the title and with the formula. Sometimes they give you the formula and you have to name the type. So any of this. So that is why, how is this part to be studied? For the elasticity of demand and supply, you have to know the title of the graph itself, graphical representation will be there. The formula denoting that graph, the type, the name, what is there, and examples and explanatory notes we have added wherever. Why it is called as a unitary elasticity of supply. What is that definition, So when the degree of responsiveness of quantity supplied is in exact proportion to the changes in the price, you call it as unitary elasticity of supply. Like that, we have given you definitions. That is what I mean by the explanatory note. Okay, now the examples is what we are going to do under determinants of supply. Okay, so check it out. When you people who have got 5 on 5, very good. Pat yourself. And for elasticity of demand also, this holds good. Right, that's why today's class we began with an exercise on graphical segment. Okay. Now let's go for the exercise. Look at the question one by one. I will read out the question. Like yesterday, you are going to do it. Yeah. Now, my dear students, please look at it. So, some of the questions from the elasticity of supply segment is asked. Answer key is there on the B segment, panel B or segment B. Your segment B is a set of questions. Now, answer these questions. Okay. The degree of responsiveness of quantity supplied is more than proportionate to changes in the price. Then it is, the options are given for you. ES is less than 1, ES is equal to 1, ES is greater than 1, none of the given. Right? So look at the question, options are given. Second one, give the percentage formula for measurement of supply. Percentage formula for measurement of supply. Okay, right on. I told you, as we began the class, when we saw what are the important components we have to prepare from this segment. One is methods of measurement, where you have a arc method and percentage method. Now the question here for you is the percentage formula for measurement of supply. Okay, do that. The second one is, the third question is ES less than 1. Will it be for durable goods or will it be for perishable goods? See, this is an example based question. No? And they can give you the name of the perishable good itself, like fruits, milk and vegetables, or some durable commodity itself they can give, right? So they can give you practical example also. So ES is less than 1. Will it be for durable goods or perishable goods? Okay. The next one, when inputs are available. So the factors of production are there. ES is greater than 1. You have to write yes or no. Okay. What is that you are going to reply? Yes. ES will be greater than 1. No. ES will not be greater than 1. Right? Okay. And the next question is, in case of risk averse entrepreneur, what will be the ES? So here we have given ES is greater than 1. You have to write yes or no. Yeah, actually the last 3 questions are you have to write either yes or no. Yesterday we did not true or false, correct, incorrect, like that, yes or no. Okay. Now in the short run, yes is less 1, true or false, or yes or no. Let's keep the last 3 as yes or no. Now my dear students, you have to understand that short run we have taken because time factor is a determinant of elasticity of supply, isn't it? Entrepreneur we have taken because his risk-taking ability is a determinant of elasticity of supply. Availability of infrastructure, availability of inputs is a determinant of elasticity of supply. Nature of the commodities is the elasticity of supply. So from that segment, I've taken these questions. Okay. So please write the answers, and when you're ready, tell me. I will release the answer key. Or you can even tell the answer. Yes, I think I gave you some time. Now time up. Let's go for the answer key, right? Check your answers. in the first case, the degree of responsiveness of quantity supplied is more than proportionate to changes in price, which means ES is greater than 1. Why more than proportionate? Because it is driven by price. It's driven by price. Literally speaking, it is driven by price. This is driven by price. Okay. That commodity, whatever be the reasons. Okay. Second one. Percentage formula. So let us write here because it involves delta and all. So let us write the formula expression for percentage method. So ES, it can also be small es is equal to delta Q by Q divided by delta P by P. But you may say, ma'am, it looks like quantity demanded. How did we do in the class? To indicate supply, we will very clearly denote QS. Delta QS by QS divided by delta P by P. Percentage method. Okay. Got it? Then tick mark. Now third question. When ES is less than 1, it is perishable goods. Why is it so, ma'am? If you want to ask, maybe you also know the reason. See, perishable goods cannot be driven by price because the longevity is very less. The prices of flowers may go up early morning. That doesn't mean that a flower vendor would stock or take more goods than usual, more quantum, because he knows that at the end of the day, when it is not sold, he has to throw it away. So it cannot be driven by, that's why ES is less than 1. Whereas durable goods, it's not like that. He can stock it, he can also sell it sometime later. Remember that. Okay. This all we did that's where I said in explanatory notes we have done. When inputs are available, yes, ES is greater than 1. What is my problem now? I have my factors of production ready. Okay, I will start production. As simple as that. When I don't have, when factor constraints are there, ES will be less than 1. Okay, logically thinking you get the answer. So though we are giving it in the formulaic pattern, logically you think you get the answer. As simple as that. In case of risk-averse entrepreneur, who is risk-averse entrepreneur? One who is not adventurous, one who is not ready for challenging investment proposals. He says, I want to do a safe play game. He is speculative. Entrepreneurs are speculative. There is no doubt upon that, right? But what is that we are trying to say here is, there is a difference between entrepreneurs, as we did in the class extensively, risk neutral, risk preferer, risk averse. Can you recollect this? And yesterday the point I was making, when you attend the revision session, what basically you are doing is you are getting back to the classes you attended, the lessons you studied. Oh, somewhere I heard this. And then you recollect, and that's what I found people doing. How did they do this exercise? Yeah, somewhere I've heard the name of this economist. This similar exercise we did in the class. Yeah, this formula I can recollect. So that is what is going to happen in the revision class. It's not learning something new, right? What we did, you are trying to now directly you're having some exercises, very important questions, and you're trying to recollect. Okay, so in case of risk averse means what? I am not the one to take up risk. So what will happen? Is a ES greater than 1? No. He is not ready for risk. That's why ES will be less than 1. In the short run, is ES less than 1? Yes, because short run is a period which is not adequate for the entrepreneur to make some changes. See, he wants to augment the supply of the commodity because he finds that the prices are going up in the market, but he is unable to do. There are certain arrangements he has to do. So for the long run, it will be ES greater than 1. For short run, it is ES less than 1. Now, this exercise, my dear students, is to typically say that they would give you, the question would appear technical, like ES greater than 1, less than 1, highly elastic, highly inelastic, but please remember, logically, if you think, you can know the answer. That is why I told you that in our material also, factors determining demand, or factors determining elasticity of demand, factors determining supply, factors determining elasticity of supply, all these are given with examples. I used to say example based segment. That is what it is. So have you all noted it? Have you all noted this exercise? All of you? So I move on to the next one. Okay. Now you are going to identify the type of elasticity of supply from the graph. It's a graphical exclusive, this page. So we saw completely, this kind of a question on this. This totally a graphical segment. We began elasticity of supply with a graphical segment. Then we moved on to a couple of questions on the theory part. Yes, I think you understood that. And now again back to the graphical segment. Okay. What type of elasticity of supply is shown in this graph? We saw the types: perfectly elastic, perfectly inelastic, unitary elasticity, relatively elastic, relatively inelastic. What do you find? What is the most suitable one? And what is the type which is depicted here in the? And by the way, note it as a important question to revise for the exam. That is why I started today with this graphical. The first exercise we did was identifying the type of elasticity of supply from the given graphs. You remember that exercise all? Yes, the answer is relatively inelastic supply. Okay, so of the options given, from perfectly elastic, perfectly inelastic, relatively elastic, relatively inelastic, relatively elastic, this is the most appropriate, and this is the answer. For a greater change in price, look at the change. There is a change in the supply, but relatively less. It is not zero. The degree of responsiveness of quantity demanded, quantity supplied is not zero, but less than proportionate to the changes in the price. Degree of responsiveness of quantity supplied is less than proportionate to the changes in price. And look at the numbers also added: 100 to 150, 40 to 45. Are you clear? So this is one repeated question. Make a note of it. Graphical segment. So when you're revising elasticity of supply, be sure you are definitely going to do this exercise. Definitely. So I wrote it. I think yesterday in the poster which I sent also, I made this. Revising this graphical segment is extremely important, because there you should not waste your time looking at one graph. It should be in your fingertips. Are you clear? So looking at this graph, yeah, I know what is this. And what are the things you have to know? The title, of course, the graph is given. What is the formula that denotes that? When we draw the graph, you must be able to tell the formula. Examples, relevant example. Notes, anyway, these two you are going to study it there. So when I looked at this, I know that it is ES less than 1. Okay, it is not equal to 1. It is not greater than 1. It is not infinity. It is not 0. I must be able to say the formula also. Are you clear? Yes. Now we move on to equilibrium analysis. So we are moving on to the next lesson. Okay. Now, regarding this lesson, one important exam cue is this. Revise a fundamental graph and go. Excess demand, excess supply. Unless and until the fundamental graph is there in your mind, you cannot address other questions, because this is out and right a graphical topic. You remember we saw each graph as case 1, case 2, but they cannot show the graph, because when they show the graph, the answer will be evident. So how they will give you is what is the statement I've given you there. When there is a simultaneous rise in demand and supply, and the rise in supply is greater than rise in demand, what happens to price? So without the graph, you should know, okay, both the demand and supply are rising. Rise in supply is greater than rise in demand. What will happen? Can you understand? So this is going to be my fundamental graph. I have a downward sloping demand curve. I have an upward sloping supply curve. And I determine this is my equilibrium point. And I trace it, and this is my equilibrium price. This is my equilibrium quantity. If I go beyond this equilibrium price, what is happening? My supply is greater than demand. Naturally, price will fall. If I fix a price below the equilibrium price, what is happening? Demand is greater than supply. So naturally it has to go up. So unless you understand this excess supply situation or excess demand situation, the fundamental graph, you cannot touch any question in this segment. So what is your exam cue for this lesson? I will be thorough with my fundamental graph. This is called as a fundamental graph. Okay. You want me to draw? I will draw it also. Yeah. So my equilibrium point, I told you that, no, remember, point of saturation, point of equilibrium, point of inflection, all these points, here it is equilibrium point. Point of saturation in DMU, isn't it? You remember that. I do not want any more point. Now this is my equilibrium price. So this is the fundamental graph, and I have questions for you. You are going to look at those questions also. This is my equilibrium price. OP is my equilibrium price and OM is my equilibrium output. Now what if we fix price at P1? Now look at this. Make it as point A and B. What do you find? Your supply is P1B, whereas your demand is P1A only. So excess supply. And what will happen when there is an excess supply? When the supply is greater, it will bring down the price. Here itself you are learning the logic. That is what we are going to ask in the question. When supply is greater than demand, when increase in supply is lesser than increase in demand, that is how they are going to word it. So if I have this fundamental graph in my fingertips, I can address any question. And for this chapter, which is totally graph based, they are going to give you a statement. You visualize a graph and you answer. They can't give the graph because answer will be there in the graph. That is the challenge of this topic. Okay. Now, if the price is fixed at below the equilibrium, what happens? You remember all this we discussed, and I told you that why it is called as therefore equilibrium price. Because anything above that or below that is causing an imbalance. And totally it will get back to the equilibrium price. So this is a kind of a static price. A price, equilibrium price is a state from which there is no tendency to change for a for a specific period of time. That's how we saw it, right? So we can mark it here as C and D. Now here P2D is your demand, P2C is your supply. So this will be your excess demand. Yes or no? Now remember this. Now because of this excess demand, when there is greater demand, what will happen? Price will increase. So you are learning this logic here, and then you can go to the question. Okay. So now take up this question. I've made some questions, a small exercise for you. When the demand is constant, read the question properly and then answer. When the demand is constant and supply reduces, remember demand is constant. Assume that graph, no change in the supply is reduced. What happens to price? I also have the graphical representation, but I will give it to you later. What happens to price? You think and write. I give you a time. Did you get the answer? So answer key for you. Demand is constant, supply reduces. So it is a case of excess demand, price rises. So demand is the same only, but supply is reduced. What will happen? It pushes up the price. Excess demand situation, price rises. Okay. Options I've given, and the answer is, say they will give you options like this. Price rises, price falls, equilibrium price changes. It depends upon many factors. Okay. And when you look at the graph, answer is evident. That's why I told you that they cannot show the graph, because answer is there. This is how, I have given the graph fulfilling the condition. Demand is constant. You see one D curve, demand curve only, but two supply curves. And supply is getting reduced. Yesterday also we saw, isn't it? And when we did supply, how it will shift left to show a decline. See, supply quantity gets reduced from Q to Q dash at SS dash level. Now here, demand remaining constant when supply reduces, price goes up. From P to OP dash. So this is how the question will be. You will not get this graph. They will ask you the question and options will be there. You can visualize a graph or do it in the rough working column and do it. Are you clear? Okay, one more example we will try for your confidence. No? When the increase in supply is greater than, remember, increase in supply is greater than increase in demand. What is happening? What's the meaning here? Supply is more. Isn't it? Greater increase in supply is greater than increase in demand. Excess supply situation. What will happen to price? Graphical representation is there. So look at this. Increase in supply. Do you see the shift now? Bigger shift. Increase in supply is greater than increase in demand is also shifted. It's not a constant like the previous diagram. See, look at the difference between the two diagrams. There it was only one demand curve. Here, two demand curves. Demand curve is increasing. Shifting towards the right, increasing. It's increasing. Supply is also increasing from SS to S1. Increase. But increase in supply is greater than increase in demand. So the answer is price falls. Price will fall. Are you clear? So how am I going to attend the equilibrium analysis? Similar only. I think as a table also I've given in the material. You can just look at that also. How, where quantity demanded will be equal to quantity supply. And excess supply, excess demand. Even as a table you can show that. And even as a, what do I say? Even as a graphical, you can understand that. Right. Okay. Now, this is the answer. Please understand it clearly. So, what do? For equilibrium analysis, I study the fundamental graph. I understand the logic. When there is excess supply, price will fall. When there is excess demand, price will rise. This is a fundamental premise. Now, they give you a question. If you are able to visualize the graph and answer, fine, because graph will give you the answer. Or you want to draw it in your working sheet or working column, you can do it and give the answer. Are you clear? Yes. So we are now moving to indifference curve analysis. Okay. Don't worry, I will give you a break at 7:30. Okay. Now just I'll give you a small note on this topic before I ask two questions. Okay. Some little bit of, framework, recollection is needed before we do it. Okay. Indifference curve analysis, popularly known as IC. Now here, please remember, this is an alternative. These are the key points, exam oriented points I'm giving. As an alternative to Marshallian utility analysis. Marshallian utility analysis. Remember, who gave this? Okay, you have to know because you're going to do that exercise. Who gave this? Upon what approach it is based? Okay, then properties. From properties, I've added questions from all this, don't worry. Properties. Okay, and this consumer equilibrium through indifference curve. I think 9 properties we did, if I remember. No? Then consumer equilibrium through indifference curve. Consumer equilibrium through indifference curve. There you have assumptions. Okay, and you also learn this concepts, several related concepts. And that is also a question. In that question, it's there. You will know what is that concept about. So this is how you are going to revise for the examination. It is an alternative to Marshallian utility analysis. Please remember. Okay, and as we discuss the classroom exercise, you will know how or in what way it is different. So that is how you have to prepare. You do ICA having in mind that it is a kind of an alternative approach to the Marshallian utility analysis. In what are the ways they are different? That's how you have to revise. Okay, technically speaking. And I'm not giving more points here because in the classroom exercise, that's what we are going to discuss. Okay. Yes. ICA, indifference curve analysis, was given by. Okay. You have to find out the answer. The approach lays emphasis on measurement of utility. True or false? I will increase the font size. The font size was made big so that it is clear to you. So now you can do the exercise. Okay, and as usual, answer key will be released for you. Okay, ICA was given by, so I have given you the options Marshall, Hicks, Samuelson and Robbins. Right. This approach lays emphasis on measurement of utility. Is it true or false? IC analysis uses which one of the following tools to determine consumer equilibrium? 4 tools are given as options. ISO cost, ISO quant, budget line, all of this. Right. Next one. One of the properties of indifference curve is two indifference curve intersect each other. True or false? Higher the IC, dash the level of satisfaction. So I told you, from property segment also I'll ask you. So this is a kind of the model questions from this chapter. You can take it in that way. Probably they will ask another property, but I have covered to the possible extent the entire topic under this exercise segment for you. Okay, IC can touch x-axis but not y-axis. True or false? Expand MRS. Okay, expand MRS. MRS generally will be, means there I want you all to write whether it will be increasing or decreasing. Increasing, decreasing, constant, none of the above. Okay, for MRS, you can keep these options. For MRS question, you can have these options in mind. So they may give you some options like this. Okay, so that's why I gave you this. Okay. Now IC follows dash approach. You must be knowing yesterday when we did DMU, Marshall and Utility Analysis, we have completed the revision of that topic. I gave you the hint on what it is, right? IC is based on indifference curve, is based upon dash technique. Numbering is followed in ICA. True or false? Okay, you have to say numbering is followed in ICA. True or false? The next question, or the last question here is IC curve is convex, concave, vertical and horizontal. Please do this exercise. I'll give you just 2 minutes. Okay, fill it up. Answer key is ready for you. Don't worry. Okay, authentic answers are there. Not to worry. Okay, time up. So I am releasing the answer key. Check it. Oh, this is also very small, no? I will make it bigger. Font size is small, I understand. Okay, I will show you the answer key now. These are the questions. I've increased the font size, that's why I just took a pause there so that you'll be able to, correct it if there is any mistake also. ICA was given by, please remember, Professors Higgs and Allen. You know that, isn't it? So it was Marshall who gave measurement of utility, quantification of utility. Now, indifference curve analysis is, we call it as an alternative method because the proponents of this method believe that utility is a subjective phenomenon, it can't be quantified. So better we do ranking or ordering. Ranking of preferences, ordering of preferences. In the classroom, we did that exercise, scale of preferences. When a sum of money is given, how would you allocate it among different items of your expenditure based on priorities? I think you started with transport, food, mobile recharge, stationery, snacks or entertainment. Order, the priority was given, right? Ranking. So here, the proponents of indifference curve analysis, they believe that it is very difficult to accept the fact that that utility as a state of mind, expected state of mind, can be quantified. It's not possible. And in Marshallian utility analysis, quantification or measurement of utility is done. And we also have a term for that, utils. They can ask you, isn't it? Utils is a yardstick we use to the consumer by eating one mango got 50 utils. That measure of satisfaction in terms of utils, utils. You remember that? And as he took the second mango, the utils came down from 50 to 40. So that is not accepted by this school, and that is why we call repeatedly indifference curve analysis as an alternative to Marshallian utility analysis. Okay, are you clear? Right. So who is the answer here? Allen is not given, but among the four, Hicks is a appropriate answer, because indifference curve analysis was given by Professors Hicks and Allen. This approach lays emphasis on measurement of utility. True or false? False. It's against measurement of utility. It says quantification of utility is not possible, is debatable, because utility is a subjective phenomenon. Didn't we study that even in Marshallian utility analysis? Yesterday we did, no? We revised it's a subjective phenomenon. It's a psychological phenomenon. Then how would you? We saw the difference between utility and satisfaction. Satisfaction is a realization. I possess the commodity, I consume the commodity, and I say I'm satisfied or not. But utility, even looking at the billboard, I get impressed. I feel that by having that, by possessing that, by consuming that, I feel satisfied. So how can that be measured is the argument here. So the answer is false. Please check your answers. Okay. IC analysis uses which one of the following tools to determine consumer equilibrium? Make this as a very important question, technical question. My dear students, the answer is budget line. Please remember, isocost and isoquant are used in producer's equilibrium. Here we are discussing about indifference curve is a consumer equilibrium analysis. Indifference curve as a technique is used, as an approach is used in consumer equilibrium. In producer's equilibrium, we have two tools, isocost and isoquant. Here, in consumer equilibrium, in ICA, we use budget line. Okay, right? So, what is the correct option? Option C. Okay. Then, one of the properties of the IC curve is two ICs intersect each other. It's false. Note that answer, it is false. Okay. The answer is false. Okay. Have you noted that? It's false. Okay, what is that false? That is, one of the properties of IC curve is two indifference curve intersect each other. False. Indifferent curves do not intersect each other. They are not tangential to, they are not tangential to each other. We saw that. Okay. Higher the indifference curve, higher the level of satisfaction. First property. You remember that? Each indifference curve denotes a particular level of satisfaction. Higher the indifference curve, higher the level of satisfaction. When more number of indifference curves are there, it is called as an indifference map, family of indifference curves. There only we saw no IC1, IC2, IC3, IC4. And each level of indifference curve denotes a particular level of satisfaction. Recollect your graph. Okay. Then IC curve can touch x-axis but not y-axis. It doesn't touch x or y-axis. We know that, isn't it? So it is false. It doesn't touch any axis. Expand MRS, marginal rate of substitution. So I have a small table also for you to do MRS. Okay, what is MRS? That is, it's a rate at which a consumer is willing to sacrifice certain units of Y commodity for one more unit of X commodity. Isn't it? That measure is technically known as marginal rate of substitution. It's an important measurement as far as indifference curve analysis is considered. Right? Okay. Have you noted down the expansion? Was it correct? Did you do it correctly? Okay. MRS generally will be declining. I was giving you the option, no? Declining, increasing, remaining constant. It depends upon the nature of the commodity. It will be declining MRS. Okay. Then IC follows dash approach. Ordinal approach. Cardinal is numbering. Ordinal means ranking or ordering. So Professor Hicks and Allen has indicated that we are following a ranking method. Okay, so it is ordinal approach. Whereas DMU is cardinal approach. Yesterday also you did that exercise. Okay. IZ is based upon dash technique, scale of preference technique. Remember this point very well. The technique which are using here, I mean, scale of preference is a premise also, you can say. Preferences of the consumer. That's why ranking and ordering terms. Numbering is followed in ICA, yes or no? False. Numbering is not followed. Numbering, quantification, cardinal, all those are Marshallian utility analysis. In Hicksian analysis, this is Hicksian analysis, no? Indifference curve analysis is Hicksian analysis. We are following only ranking or ordering, not numbering. And what is the nature of IC curve? Is it convex? Is it concave? Is it vertical or horizontal? It is convex. Look at the answer. Convex. Are you clear? Check your answers with the key released. The key is perfectly correct. It has been authentically taken. So there is no doubt about the key. So if you have made a mistake, please write the correct answer there. So it's almost close to an hour. So I give you a small break, 10 minutes break, because we have to go on to till close to 12, probably 11:30 or 12. I will see accordingly how much of the targeted we have done. So far, with your cooperation, we have done a very good use of this 1 hour time. We started exactly at 6:30, 6:31 or something. And then for 1 hour, we have done elasticity of supply, equilibrium analysis, and we are doing indifference curve analysis, right? So take 10 minutes of break, and we will be back by 7:42 or something like that. So I think this part of indifference curve analysis is very clear to all of you. As I told you, maximum number of questions I have taken from the chapter, very important ones and also repeated ones, right? Now here, look at this particular graph. It is talking about one of the properties. It is talking about one of the properties which is very important. You have a graph here given to tell you that from the graph also you may have to identify the property. Now they give you a graph and they will ask you to identify what property does this particular graph highlight or hint. We all know that it talks about indifference curves which cannot be parallel to each other. The reason obviously is given, this is because the MRS may differ for different indifference curve. IZ1 is constructed on a different MRS, IZ2 is constructed on a different MRS. So how in that case it can be? See, most of the books, when you give a curve like this, indifference curves, you have good X, you have good Y, origin. So when the books give you something, we tend to believe it is parallel. That's what I used to tell you in the class, no? So this is IC1, IC2, IC3 and so on. Right. So here you find that I give a graph and I identify what property it is. So the answer is very obvious. Should the indifference curve be parallel to each other? They are not parallel to each other. That is the answer. No, you can identify the property. For maybe it cannot be tangent to each other. It should not touch the x and y axis. So for that matter, this is one type of question I'm telling you. So they can give you the graph, and based on the graph, they can ask you a question on the property, right? Okay. Now, what is that you have to focus for the examination? Very important is the calculation of MRS is there. And how does the consumer equilibrium using indifference curve appear to you, right? Now this small calculation, you can just do it, isn't it? We know what is MRS, as we already have discussed. MRS is the difference, or what you can say as the number of units of Y commodity a consumer is willing to give up for 1 unit of X commodity. So I have my MRS as 1:4, because from 1 unit of bread to 2 slices of bread, I am giving up how many units of fruits? I was having 12, now I am having only 8, so I have given up 4. So in the second case, it is 1:3. The third case, it is 1:2. Right. Okay, so it will go on like this, right? It will come up to say 4, 3, 2, and it is 1:1. So what is the meaning? For 1 unit of X, okay, which I want, the number of units of Y I sacrifice. For the unit of X I gain, the units of Y I sacrifice. That is MRS equation. So you have to revise this also. Now coming to consumer equilibrium, we all know that IC1, IC2, IC3 denote what? Indifference curve. I think the map is very clear to you. The board is visible. So this is IC1, IC2, IC3. Okay, curves. And what is this line? This is the budget line. The point where these two are tangent, the point of tangency between the budget line and the indifference curve is your equilibrium. You remember that? And I told you, anything beyond that is not affordable, because budget stays here. AB is your budget line here. And anything below, you still have scope. So I need not have to stop at IC1. I cannot have IC3. What can I have? IC2, because my budget and my satisfaction coincide. The tangency of both. So what is the tool you are using here in consumer equilibrium through indifference curve? We are using the tool of budget line, the point of tangency. See, you guys see two commodity, dairy milk and Kit Kat. They can give you practical examples like this. So two questions, the numericals are the table and the graph, which is a missed not segment. I must do it for my examination. Is this. Are you clear? Yes. So it could properties from the graph, properties correct and incorrect, fundamental questions from the chapter, all template questions with answer key has been given, and the two ingredients, main ingredients, we would call, of this chapter is, one is the computation of MRS for a numerical segment and concept wise also, and the other one is the equilibrium point through or using indifference curve approach. Okay, revise these two segments. That's what I've written there. Revise. And also point above, not affordable, beyond the budget. Point below, still budget is permitting you. All that you have to do. Are you clear? Yes, very good. So maintain your revision note till all my 5 days, because you can note it down. Now we are entering into theory of cost. Okay, we are entering into a segment called as theory of cost. Now basically there are some types of questions which are repeatedly seen. Okay, and in our we will be seeing in some of our session also, in our class today, which I've added here. So let us see, we are yet to see that. So So some template questions are also taken. Segment wise, if you ask, ma'am, what is important in theory of cost? First of all, different types of cost with examples. How many types we saw? No? The chapter began like that, isn't it? So historical cost, replacement cost, sunk cost, marginal cost, total cost, average cost, semi-variable cost, step costs. Remember all this? Social cost, private cost, outlay cost, traceable cost, non-traceable cost, explicit cost, implicit cost, accounting cost, economic cost, opportunity cost, real cost. How many? So, cost types with alternative names. For example, implicit cost, I also call it as imputed cost. Traceable cost is also known as direct cost. You understand that? Right. So, all these you should know. Then, so that is the first thing you're going to see. I'm giving you a broad framework. Miss not points. Okay. I'm giving you here. Then we will do exercise. So how should I prepare this? Revise, not prepare. By now preparation should have been over. How should I revise this chapter for the exam? What should I do? Okay. Do the revise different types of costs with examples because we have it in the material and everywhere it is given also. And alternative name of the cost. If you have, as I gave you some examples, no, imputed cost as implicit cost. Okay, like that. Now TCMCAC calculation. Fortunately, yesterday also we did TUMU. Isn't it MU from TU from MU you saw. It is there in the class. In the class itself, we have done examples. I think in the questions, which we did not test, class tests and the assignments I've sent, you have also those types of questions, right? Okay. What to say is numericals. Then, so TCMCAC, total cost, marginal cost and average cost for numerical and graphical representation. You're going to revise. Fixed cost with and variable cost with example. Fixed cost or incurred upon fixed factors. So what are fixed factors? They don't get exhausted with a single use. They can be put to repetitive use. It's a big budget decision. And it will have to be incurred whether or not you require them. It has to be incurred whether or not a production is happening. Whereas variable cost depends upon what? Variable cost depends upon what? Variable cost depends upon, use or need for variable factors. And when do we require the variable factor? When the production process is on. Do you follow that? Okay. So remember that also. Short run and long run cost typically important. You will see that no, when you see the exercise. So broadly, you jot down this as an important framework for analysis. Very broadly. Yes, okay, because this chapter is very big. If you see, that is why we have compartmentalized it as an exam queue. That's all. That's what I can say you here. Sample questions based on the cues given. Okay. Dash costs involve actual expenditure of funds, say on wages, materials, rent, interest. Options are there. Opportunity, cost, outlay, cost, social, cost, none of the given. Okay. Read the question. I will give you time. Dash costs are those which have direct relationship with a component of operation, like manufacturing a product, organizing a process, or an activity. Options ready for you? Sunk cost, traceable cost, non-traceable cost, replacement cost. Then, cost refers to the cost incurred in the past on the acquisition of a productive asset such as machinery and buildings. Without options. So try this also, now whether you can recollect. We saw no different, even listed out now. AFC is known mathematically as, repeatedly I told you in the class, payments for raw materials comes under fixed cost component or variable cost component. Short run cost curve is known as, repeated question, LAC is also known as dash curve. Try this questions. I'll give you 2 minutes. All of you jot it on, very important. These are template questions. Maybe they'll ask you, instead of AFC, they may ask you what to say MC. Or in the place of the example I've given or statement I've given, they'll give you something else. But I want all of you to do this exercise, right? Because this is given based on the cues I just gave you now. I said the whole cost chapter has to be compartmentalized and studied. Don't do it at a stretch. Break it. Types of cost separately. All types of cost with examples. If they have some graphs or some illustrations. Then do TC, MC, AC computation. Separately you do it. Then fixed cost and variable cost separately you do. Short run average cost and long run average cost, SAC and LAS, do it separately because it is difficult then. So based on that cue, that segmentation only, these questions are prepared. Yes. Anyone wants to answer? Anybody is ready with your answers for this? Any of the question you are able to do? Okay. First one. Dash costs involve actual expenditure of funds, say on wages, materials, rent, interest. What is that? Options: opportunity cost, outlay cost, social cost, none. The most appropriate is outlay cost. Outlay, that itself, no? Yesterday we saw, no? Total expenditure method, total outlay method. Right. What is the outlay for? This. So that is outlay costs. Dash costs are those which have direct relationship with a component of operation. See here, the meaning of this statement is, I am able to find out where the cost was incurred. That's a clue for you. The answer is traceable cost. Because in non-traceable, which is also, and the alternative name for traceable is direct. Non-traceable is indirect. In non-traceable, there are some they'll write as general business expenses where we are not able to strictly identify the cost component. But in traceable, we look at the statement we have given. It is a direct relationship. That is why they didn't give the term direct, because you can direct cost, you can identify it, the answer easily. Traceable. It is associated with the component of operation like manufacturing a product, organizing a process or an activity. Do you understand this part? Are you clear? Okay, then go to the next one. Dash cost refers to the cost incurred in the past on the acquisition of a productive asset such as building and machinery. Historical. Very good, very good. Yes. If you know the answer, please come out. I'll be very happy. Historical. Okay, now one of you who replied, supposing I am, because of wear and tear, I'm going to change this. Okay, I'm going to purchase a new one. What is the term we can use? What cost we can call it as? I'm going to buy a new one. I'm going to change it because the existing one has been subjected to wear and tear. Okay. So in which case it is replacement cost. Remember that. Okay. AFC is known mathematically as, you have the answer? Rectangular hyperbola. Remember that we saw, what is a hyperbola, what is a rectangular hyperbola, why it is called as a rectangular hyperbola. detailed way we have seen that. And I told you that shape of the costs are very, very important. See, that is why we have to focus on it. We have to focus on it. Okay. Then, payments for raw materials comes under what cost can I call it as? Can I call it as fixed cost? Can I call it as variable cost? What is that I should call it as? Certainly it is variable cost. This is where I told you that take that segment separately. We have listed out fixed factors, example. Fixed cost, examples. Variable factors, example. Variable cost, examples. Do it very appropriately, right? Now, shortened cost curve is also known as repeated question, my dear students. It is a misnote one. Misnote one. Plant curve. Because in the short run, we saw with a diagrammatic representation, if you can remember, in the short run, you can vary your output by varying only the variable factors. You can't vary the fixed factors. Like a plant curve, it gets stuck to a particular plant. That's why short run cost curve is known as plant curve. You remember there was an organization, a firm, which wanted to expand its level of output from OA to A dash, and because of that, it was not able to do it with a graph we saw. You remember this, where we discussed, So this firm is producing OM, and the one indicates the plant, the plant one which you're using. And this is the short run average cost of using this plant to produce OM at a cost of PM. They wanted to go for an output expansion. They target M1, and they make a cost estimation. They find out that if they use the same plant, the cost they have to incur is PM1. Supposing if they insert another plant, it will be SM2, SM1 only. So when I have a second plant, my cost is going to be optimum. When I'm going to produce this expanded output with using plant 1, then my cost is going to be PM1, very high. So I have to abandon the plan of output expansion. Why? Because in the short run, more fixed factors cannot be added. Fixed factors can be varied only in the long run. Plant is a fixed factor. Plant, buildings, machinery, equipments, factory installations, all are examples of fixed factors. So basically, you can't go for another plant in the short period. So when I'm making an estimation, I'm just thinking, with this plant, what would be my cost for producing the desired level of output? It is PM1. If I add another plant, it is going to be SM1 only. but I'm not able to add. So it gets stuck to a plant. Therefore, it is called as plant curve. That is the reason why it's called as plant curve. Why it is called as plant curve? In the class I revised with you. No, I'm just trying to give you this diagram. Whereas if you look at the LAC graph, no, remember this? Do you remember this graph? SAC1, SAC2, SAC3, SAC4, SAC5. And I am going to see all this. Link it up, all this. A family of indifference curves. Family of short run average cost curves. See, you're getting a boat-shaped, flattened U LAC. LAC embraces a family of short run average cost curves. So now, in the long run, there is an opportunity for the organization to choose plan 2, to get plan 3, to have plan 4, because it's a long run. So fixed factors become variable in the long run. That is why the difference between fixed factors and variable factors cease to exist in the long run. Okay, so look at the short run curve. This was not possible. We didn't have this scenario in the short run. Oh, no. I have to be stuck to this plant. I cannot choose this option. Though I know that to produce OM1, SM1 only will be the cost. But I have no option of this. We are still giving it as SA2, SAC2 because it's an estimation done during this period. I want to go for an expanded output. I do a cost estimation. With only one plant, my cost is huge. I didn't think that supposing I install plant 2, will I be able to manage a cost? I am able to work out a better cost. Look at this diagram. The graph is an explanation. That is why we say it is sticking onto a plant. Are you clear now? Yes, that is what I wanted you all to understand. Okay. Now, short run cost curve is known as plant curve. I deliberately taught you this for only one reason, because it is a repeated question in the examination. And LAC is a planning curve, envelope curve, flattened U, boat-shaped curve, U-shaped curve, all that. Right? So remember why SAC is called as plant curve, why LAC is called as planning curve. I have a choice. I can choose between the plants. I can install plant. I can buy plant, because it's a long run. So I remember students saying, ma'am, suddenly we will not remember why it is plant curve and why LAC is planning curve. I am giving you, I am revising that. I just revised you with the graph itself. In SAC, it sticks to one plant. I cannot have the option of going for another plant, machinery and equipment in the period. I cannot do that. So what do? I get confined. So it is plant curve. Are you clear? And planning curve is I have the option. Now a few more exercises. Costs incurred towards salary of the foreman will have a sudden jump if another foreman is appointed when the output crosses a particular limit. Okay, so what is that cost? The second one is economic cost is equal to, is explicit cost plus one more cost is there. When an entrepreneur invests his own resources, he should be treated as a factor, and so he should also be paid. Okay, he should also be paid, which is dash cost. Dash cost. Then dash costs are entered in the books of accounts. Think of names, any name would do fine. Private cost plus dash is social costs. See how we are taking intricate questions for you. Who gave opportunity cost? We have given you options. Marshall, Ricardo, Vizier, none of the given. Try this. I give you a minute. Because these questions, yeah, just see how they have highlighted the importance of these questions. Have you done? Okay. Remember, you see how cost topic is. And I'm going to just mention about your uh, economic cost and accounting cost. We will revise that before finishing this segment. Okay. Cost incurred towards salary of the foreman will have a sudden jump if another foreman is appointed when the output crosses a particular limit. It is none other than your step cost or stair step cost, right? It's none other than this. Second, economic cost is equal to explicit plus implicit cost. The other name for implicit cost is imputed cost. Please remember, the other name for implicit cost is imputed cost. Are you clear? Yes. Now, again, when an entrepreneur invests his own resources, he should be treated as a factor, and so he must also be paid implicit cost, isn't it? Explicit is what you incur on your actual expenses that are recorded in the books of accounts. They are incurred. They are there. But here, the entrepreneur, he has invested his resources, sacrificing an alternative. That should also be included. Okay. Then dash costs, anything you can write, outlay, explicit, accounting costs, whatever it is, they are to be entered in the books of accounts. Okay. Private cost plus external cost is social cost, because in private cost, actual expenditure alone the entrepreneur calculates. Whereas there are other costs. We said no, but to address the pollution problem. When the water is contaminated, I have a water treatment plant. These are costs which also has to be taken into consideration. That's what we say as social cost. So what differentiates a private cost from social cost is the external cost. For that, I think we did a detailed discussion on externalities. I remember that. Who gave opportunity cost? Economist Weiser. Are you clear? So now, I think this graphical part also for your revision, you took it down. Here, I write a point. My dear students, please note this point very clearly. This is going to make a lot of difference when you're thorough with this. Any type of question. See, isn't it a conceptual discussion? See, how many lessons we are doing? No, this is for conceptual clarity. They'll ask you on the concept itself. How many lessons we have told like that, right? Now here, this is the major difference between the accountant's perspective and economist perspective in cost. So an economist says that it is not only the actual expenses which are incurred and entered in the books of accounts. We need to take what the entrepreneur has contributed also as a cost, but give it a name as implicit cost. Whereas accountant's cost will be only book cost. That which is actually incurred, the actual expenses incurred, and which is entered in the books of accounts. It's a book cost. But economic cost is not like that. Economic cost is where an entrepreneur who is having, say, 2 lakhs and he can use it for lending purpose. He is having a market rate of interest. Instead of that, he is putting into the business. Business is in need of finance and he is putting it. Or he is having his own apartment which he can rent it out and make, say, monthly he can get even a 1 lakh or more. But he is giving that premise for business purpose, office purpose. So that is what is included under implicit cost, what the economists are. So that perspective they may ask you. It's kind of, certainly they can ask you the difference in the perspective, economist and accountants. So that is there. So accordingly, economic profit and accounting profit will go for a difference, right? So here it will be, for economic profit, it will be TR minus economic cost as a whole. I include the explicit and the implicit cost together under economic cost. Whereas in accounting profit, it's going to be TR minus explicit profit alone, or explicit cost alone, I mean. Do you see that? So TR, or total revenue, minus explicit cost is accounting profit. TR minus economic cost is economic profit. So these terms are very important. Right? Have you made a note of it? So in your revision notebook, if you have these exam cues, so as you prepare for the exam, you can just revise this and go, because it is going to be a question for sure. We can keep it because that's a fundamental thing. No? We begin our cost analysis itself like that, right? Okay. Yeah. So one more exercise also we can try out. Now, this is totally a segment about the shape of the cost. Make it very important. Mark it down. Take down this exam tip. Definitely the shape of the curve is asked. Okay. So you are now going to, the answers are ready for you. Key answers are there. You are going to fill it up. Okay. TFC curve is dash. See, the answer could be U-shaped, flattened U, boat-shaped, L-shaped, horizontal, vertical, okay, anything. Okay, so TFC curve is dash, MC is dash, AVC is dash, LAC with technology included, LAC under constant returns. My dear students, remember this. When I tell you that these are exam cues, you understand that they will also be unexpected questions. This you would not have expected. Because we have seen in the class the shape of LAC under variable proportions, the shape of LAC under constant returns, isn't it? So recollect that. I give you a minute or two, okay, to write the answers. Do it. And once you do know, when I release the answer key, please check your answer, and if it is wrong, note that answer key. Please try to write that answer key, correct answer there. That's what I'm expecting. Yeah. So we have thoroughly scanned the key and only giving. That's why I'm confidently saying that you can include it. Okay. TFC curve is horizontal. Check your answer. I have the clipping also for you. Next I'm showing you the graph, but it is horizontal. MC is U-shaped. But when we do that, when we do our equilibrium point, no, we will do like a tick mark. You remember? I will tell you that no, there is a portion there because it will get cluttered. You know, so many curves are there in equilibrium analysis. No, MR, MC, AR, AC. So we will do it. We will be drawing like this. Your MC like this, but actually it is full. This is your MC. Okay. So now let's move on. Where is it? Yeah, U shape. AVC. Also U shape. AFC, AVC. Okay. Then LAC when technology is included. When we don't take, when technology is assumed to be constant, it will be flattened U. Boat shaped. Isn't it? Like an envelope curve, planning curve. What we saw? U-shaped curve we saw, no? I think I drew that curve also for you. See, flattened U, boat shaped. But we saw, I told you that they can ask you this question where it can be L-shaped. Okay? Sorry. LAC under constant returns is horizontal. Please check your answers, my dear students. Definite question. TFC curve is horizontal, MC is U-shaped, AVC is also U-shaped, LAC with technology included is L-shaped, LAC under constant returns is horizontal. I will draw the diagram, you will know how it is. This is one LAC, no? I'll show you under constant returns how it will be. It also means constant returns, constant cost, isn't it? So, my graph will be like this. I'll show you how it is horizontal. SAC1, SAC2, SAC3. Sorry. You see that? This is how it is. See? So under constant returns, the shape of LIC is different. Now look at the previous one. This one. This is the difference I want you all to note it. Are you clear? So shape of the curves, all curves, cost curves, you are going to revise properly. 100% expected question, we have to do it. So when I show you the curve, look at this. Have a look at these curves. See, TFC, straight line. horizontal line parallel to the x-axis. Look at TVC starting from the origin. Look at TC, combination of TFC and TVC. Look at this curve. Maybe I'll make it a little big for you because all okay. Now look at this AFC, rectangular hyperbola, AVC, U-shaped curve, ATC, combination of AVC and AFC, MC curve. Because this portion is U only. And as I told you, when too many curves are there, we will show it like a tick mark. Note this very much. Very important, okay? Have a look at these curves so that you will understand why it is important. Yeah, it's going to be close to 2 hours. I give you a breakfast break now. It's also going to be 8:30. So, yeah, it is 8:31. So, 9 o'clock we can resume the class. Okay. So, we will continue further. I have few more graphs and numericals, etc. Likewise for revenue also. And then we can enter into the next segment. So, the class will be till 11:30 today. Remember all these points, okay? Particularly this, the difference between the two, very important. So we will meet after the breakfast break, okay?